Hello, good morning. Welcome to Core Finance. I'm Matt Brown. It gives me great pleasure, as always, to introduce Marc Ostwald, strategist from ADMISI, onto the show this morning. Good morning to you, Marc. With no further ado, let's crack on with the headlines. Well, UK GDP numbers just out, being in focus. Stronger number than expected. Pound has strengthened, so we're seeing the FTSE give up some of its gains, if we can call them that, and China selects a new committee. So starting off with the UK GDP.
Well, starting off with the UK GDP numbers, that's a pleasant surprise. Obviously, bolstered primarily by the contributions from manufacturing and from the services sector, despite the weakness that we're seeing in consumer spending. And following on from the comments that we had from Mr. Hammond yesterday about the UK economy being pretty much close to full capacity, I think this cements for markets at least the view that the Bank of England will hike rates in November, though as oft discussed before, it really depends what happens after that, but this certainly contributes to people, cementing those expectations. New Chinese Politburo, well, the only person surviving outside of President Xi is Premier Li, and the rest are basically new boys. The surprising aspect to this is when you look at across the other five who've been promoted, is there's no one obvious there who might even take over from Xi.
Apparent, is there?
So there's no heir apparent. So it does concentrate a lot of power in the hands of President Xi. And one does have to wonder where this leaves China in terms of reforms, whether this will actually see an even more overbearing party apparatus in China, which might bear down at the margins, particularly on the more innovative sectors of the economy. So we're going to have to keep a very close eye on here what the initiatives. We know that he's going to carry on with the anti-graft campaign, with the anti-corruption, but it's how he deals with obviously those sectors which have a lot of debt, have a lot of overcapacity, and how he gets the economy to rebalance away. And also how much encouragement is given to the tech sector, which is clearly supporting the Chinese economy, or how much he interferes in that area. So a lot of things to ponder, the end game of which we probably won't know for quite a number of months.
And that's probably why there hasn't been a big reaction in the market, because it's a case of wait and see what the policies are, and how that develops.
Very much so. Very much so.
Good stuff. Looking at a UK stock this morning, Lloyds Bank, Q3 numbers out this morning. Actually, I mean, the headlines look okay. The full-year guidance has been raised. No more PPI impairments, which is a pleasant surprise. Yet the stock is trending down 1.5%. So, I mean, reading through, they've recently taken over the MBNA credit business, and I think that could be a problem if we see loan impairments rise. And I think the market's looking at that and maybe looking and saying, well, look, Lloyds, we've got to wait until February if we're going to get another special dividend or a dividend hike. So it feels on the back of that, despite headlines looking quite good, stocks trading down a bit.
Yes, doing better just because you've got less impairments from PPI isn't actually necessarily a positive.
True.
It doesn't necessarily mean that there's not going to be problems going forward. Obviously, we have this whole investigation into the takeover of HBOS and what went on at the time. As you've mentioned, MBNA is another problem, could potentially a problem area, given that UK has a fairly substantial credit problem at the moment. So yes, they are. I mean, I think the good news within the results was the cost to income ratio was gradually improving. It's something that they highlighted, and perhaps they should be given a bit more credit for. But it's still not one of these really very dynamic businesses, and when one looks at it, it's also very much a domestically focused business. So it is subject to the vagaries of what actually happens with the UK economy over the next 18 months in relation to the Brexit negotiations.
And typically, when you see interest rates going up, the likes of Lloyds, RBS, etc., Barclays benefit from that. But I mean, my concern, if we're looking at loan impairments, we do see interest rate hikes. In theory, those loan impairments could rise, and that
Indeed.
could take the shine off any interest rate hikes that we see.
Particularly as we're seeing quite a lot of vulnerability in the property markets, be that residential or commercial. And Lloyds, obviously, being with Halifax Bank of Scotland as part of it, has an enormous exposure to the UK property sector. So you'd really want to see the better interest margins are at the margin good. But if you're actually at the same time going to see a fairly substantial rise in impairments, then that's not so much good news. It just provides a bit more of a cushion. But will it be sufficient?
Understood. And looking at the pound, all about the GDP this morning, pushing the pound against the dollar higher, and euro sterling dropping back on the back of that. Looking at cable, here below 132, it's actually found kind of a level that it seems to be comfortable with.
It's comfortable with. I think it needs something to push it. And then the most obvious event, obviously, is the MPC meeting. In one direction or another, above all in terms of the guidance beyond that expected rate hike. It also needs something more substantial in terms of where are we going with the dollar at the moment. The dollar is gradually benefiting from rising US interest rates, from the expectation that the Fed is going to be hawkish under whoever comes in, certainly of the people who are being nominated. But we're not really particularly, there's not much direction. When I left the office, we still hadn't actually managed to trade out of what is a 0.0019 trading range on dollar-euro, which probably tells you, 31.69 is hardly a big move in any case. So it really tells you that markets are really waiting, on the ECB tomorrow, and then on all the Fed-related news and the MPC meeting.
But looking at today and the calendar, something that may give some direction, durable goods, house price index, new home sales as well, and the BOC rate decision from Canada. Anything jumping out at you?
Durable goods, probably the most important one. It's important from two aspects. It's expected to be reasonably robust again. Headline up about 1%, but bolstered a little bit by aircraft. Could be higher than 1%, given Boeing sales, Boeing orders rather, almost doubled on the month. The key within it is going to be the core measures. Those have been growing, the ex-transport and the non-defence capital goods ex-aircraft, which is seen as a proxy for capex. They're expected to be around about the 0.3-0.5% level, which is extraordinarily good when one thinks that follows on 1% and 1.1% in previous months, which points then to a strong contribution from capex on machinery in the GDP numbers which we get on Friday. But I would hasten to add that that's actually not contingent on what we get for the orders numbers, but for the shipments number, which is expected to fall after two strong gains, and that will be the key in terms of tweaking forecasts for GDP on Friday.
And so in Bank of Canada, no surprises today?
Well, I think the risk with the Bank of Canada, the market's still basically saying at the latest the next Bank of Canada rate hike is coming in January. And I think with the very slow rise that we're seeing in CPI, it's still well below target of 2%. And indeed, the weakness that we saw in retail sales, which came as a bit of a surprise last week, they'll probably be pushing back on market expectations on that front. There's no doubt the Bank of Canada probably will raise rates in Q1 next year, but I think that the pace of their rises is going to be a lot less aggressive than they have been at the start of this rate hiking cycle.
Understood. Mark Oswald, thank you very much for joining us today.